Hello, everyone, and welcome back to Your Finance TV. We always have our monthlies that we break down with Jay Pelosky here, as you can see on the screen. This year, he's got a little bit of an outlook for 2024, which is fantastic. Considering the reviews that we get from everyone who watches these videos, it's great to get this outlook. How are you, Jay?
I'm good, Scott. How are you doing, buddy?
I'm doing great. It's a little different doing it on a Monday. Nice way to start the week for everyone. Okay, let's look into it. You're right. You're right in your piece, as I said, touching on the 2024 outlook and so forth in the monthly piece, which we'll go through. But you have four surprises floating in there for us, talking about the year ahead. Is there any chance you can tell the viewers a little about them?
I'm not sure, Scott. Let me think about it. Okay, for you and for your finance TV viewers, why not? Why don't we go ahead and do that? Because the 2024 outlook is always a big job to look a year ahead. The monthly that we do at TPW Advisory is typically a pretty good lift in and of itself, usually around 4,000 to 4,500 words, 20 charts and tables. This time for the year ahead outlook, it was actually came in at about a pretty heavy 6,400 words with 30 charts and tables, which I think is the most we've ever had in one document. I mean, there was just, so much to cover. And so the way we thought about doing it was we're not alone, obviously, in doing a year ahead outlook. And we can't really compete with, JP Morgan's and Morgan Stanley's and Goldman Sachs that have like 100 macro people doing all the different bits and pieces. But what we can do is leverage our independence and our tripolar world framework, which is a unique perspective on global markets and economies that we bring to the table. And as we work through that, we said, well, why don't we focus on the surprises? Because most big shops, they have to shoehorn everybody into one firm view, right? So we're going the opposite. We don't have to have a firm view. So we're going with the surprises. And so we came up with four macro surprises and then four market surprises. So my suggestion is I'll go through quickly the macro surprises. Then we can do our regular monthly going through climate, economics, politics, and policy and markets, and then end up talking about the four market surprises in the market section. Does that sound like a plan?
It sounds like a great plan, Jay. All right, so let's start with climate then as we go through that monthly piece.
No,
I
no,
see.
no, no. We're going to do the four macro surprises, then do climate.
Oh, sorry. It's all right. So,
You're
my
jumping
bad.
the gun there, buddy. Come on. Okay, so the four macro surprises.
All
The
right, go
first,
for it.
the first is that inflation is going to be lower sooner than both policymakers and the market expects. And this, I think, is really the key, right? We've been dealing with the inflation spike, dealing with the Fed and other central banks, ECB, et cetera, dealing with the inflation spikes. And we're worried about sticky inflation and how long it would take for inflation to get to central banks' comfortable levels of around 2%. And so one surprise, the first one, most important, is that we think inflation is going to reach those lower targets faster than policymakers and markets expect. And so just to give you an illustration of what that means, 2% CPI by the end of 2024 and 2% core PCE by year end 2024. And to put that in perspective, the Fed's own economic projections, staff economic projections or SEP, don't have that core PCE number until year end 2025. So that's what we mean by saying sooner than expected and lower than expected. And that's really key because, in our view, lower inflation leads to lower interest rates, which leads to a weaker dollar. And that really is a big factor for the market. So that's the first, lower inflation faster. The second is that the productivity pickup that we saw in the Q3 data, right? Productivity running at about 4.5% annualized basis versus typically 1.5 to 2. we think there's potential for a continued boost to productivity as the flexibility that firms leveraged and learned about during the last 2 or 3 years gets put into a more stable backdrop. In other words, companies should be able to do more to extract more productivity. That helps keep inflation low, helps keep growth moving forward, and that's a real key as well. So that's the second. Lower inflation first, more productivity second. The third is that we think we're very close to achieving kind of macro stability, right? And remember, a year ago when we did our 2023 outlook, the title was Return to Stability with a question mark because, we were not sure. We were more constructive than most who were expecting recession a year ago. But now we can feel like as we go into 2024, that stability is becoming visible. And I'll give you again a stat to kind of suggest that's the case, and that's the VIX. If you look at the VIX year to date, it's averaging about 17, and that is right at the 20-year average for the VIX in terms of equity volatility. So another way to look at that is personal consumption expenditures are also at a 30-year average right now, running at about 2% growth. So there are a number of data points starting to come together that suggest after the years of upheaval, the last 3 years of dealing with COVID, post-COVID, inflation spike, rate spike, et cetera, we're getting to stability, and that's obviously very important. And the fourth and final macro point is in the debate between whether we're late cycle, i.e. going into a recession at some point, versus early cycle, meaning that the 2 quarters back in 2021, where there was negative growth for 2 quarters in a row, that was the recession. We think that debate is going to be answered in favor of the early cycle proponents, of which we are one of very, very few. And again, to support that thesis, and the document itself, the monthly, of course, has all sorts of charts and verbiage, as I mentioned. But to support this argument is if we look at rates coming down, we're moving into a rate cutting cycle. Housing looks like it's bottoming. Semiconductor space is bottoming. And the manufacturing space, we think, is bottoming and turning up is something we've talked about for some time, the shift from inventory destocking to restocking. And so those 4 factors give us a comfort level that, in fact, we are in an early cycle where the global economy is accelerating. So those are altogether the 4 macro surprises as we see it that will become more visible as we move through 2024.
All right. So seeing as though I jumped the gun there, I'm going to let you have a nice sip of water to get your breath back and so forth.
Thank you.
So moving on to the monthly then, on the climate side of it, which we walk through these steps, you touched in there about renewable installations. Now, I feel like renewables are like having a little bit of bad press of late. Maybe that's just me. But on this climate space, like, what did you take out of last month and month looking ahead for it?
Yeah, it was exactly. We did focus a lot on the renewables because there's a real dichotomy that's been visible this year between record renewable installations. In other words, more wind power has been brought on stream, more solar power brought into the grid at the same time as the clean energy and renewable stocks have really been hammered. And there are a couple of reasons for that. One is obviously higher interest rates lead to more concerns by investors about new nascent industries that need financing, right? So that's certainly one issue. Another big issue that just led to a couple of cancellations of very major offshore wind power projects is that a number of these projects, when they were agreed upon, there was no inflation protection, right? Because inflation 2, 3, 4 years ago was very, very low. So people didn't worry about putting in an inflation protection component to the pricing. And so obviously the input prices have gone up and there's no ability to raise the output price. And therefore the projects become uneconomic. And that's really what's happened Ørsted, which is a Danish company, one of the world's biggest wind power generating companies, just literally walked away from a $4 billion project off the coast of New Jersey for exactly those reasons. And so, for our clients at TPW Advisory, as you know, when we have our two model portfolios, we've been able to hedge that a little bit by running kind of a barbell strategy with traditional fuels, so some energy exposure, XLE, for example, AMLP is another example, and then also tilting our climate exposure to the carbon and uranium marketplaces, which have done a lot better. Uranium in particular, URNM is up over 40% year to date. So it really has been concentrated in the solar and wind. So that's the renewable category. And so we're watching that carefully. We have taken down our positioning and exposure significantly over the last 6 months or so because of some of these issues. But now, as we think about inflation coming down, rates coming down, this sector, the clean energy, the renewable sector, should do quite well if our thesis proves correct in terms of rates coming down, because that relieves a lot of the concern over the financing, which has been, again, a big issue for that particular part of the climate space.
Okay, well, let's move on to economics as well. And I think it's no secret that you've been pretty bullish over the last couple of months on the side of it. There's been a lot of bears hunting around, but you still continue to see the signs are looking good on the global economy. Am I incorrect in that assumption?
No, we've continued to have a positive view. So in a real nutshell, our outlook for next year is solid global growth as the EU bottoms and China stabilizes, easing inflation as we just touched on, and then global macro stability built around a lack of excesses, plus fully employed workforces, which should lead to continued consumption growth. And then the fiscal support, the CHIPS Act, Infrastructure Act in the US, the Fit for 55, Next Gen in Europe. Japan just announced another fiscal package. China expanded their budget deficit a month or so ago. So there's quite a bit, actually. If you total up all the positives, there's quite a bit to suggest that again, the recession call has been pushed out quite a long way. Or as we argue, we're early cycle, and the global economy is starting to pick up, particularly with Europe and China stabilizing and starting to improve. So one issue that people talk about is, well, hey, we had such an aggressive rate hike cycle that clearly there must be something lurking out there that's going to trip us up and trip up the global economy. And again, we have a different take. Our view is that we've already been through multiple potential trip up issues, right? If you think about the tightening cycle itself, right? We're now finishing. I think most would agree that the tightening cycle globally is effectively finished. We've had the Mideast conflict, right? Forget about Ukraine and Russia, the whole issue with what's happening in Israel, the risk to oil supplies. We've already thought about that. The Chinese policy mistake with locking down in COVID, already been through that. And then the U.S. bank failures in the spring, perhaps the most recent example. So our view is that the global economy has been pretty battle tested over the last 6 to 9 months, and have actually passed those tests pretty well. Weak links, as I said, Europe bottoming, China stabilizing, particularly on the property side. We noticed that excess savings in China are starting to be drawn down. Remember, that's been a big topic in the U.S., right? Excess savings, supporting consumption. When is it going to run out? Well, now China is no different. Their lockdowns were even more severe, right? And so they have a massive pile of excess savings that just in the last month or two, starting to see those being drawn down. So we think China is bottoming and starting to improve. And so that's the outlook for the full year. Tactically, we remain focused on the 4 guideposts we've identified over the last 2 or 3 months, as you touched on. Continued disinflation in the US and Europe, global manufacturing recovery, continued earnings growth, which we've seen again, Q3, quite solid in the US and elsewhere, and then policy traction finally grabbing hold in China, which, as I said, with the excess savings being drawn down, property market bottoming, we're starting to see signs that policy traction is actually starting to be gained. So put that all together, no recession in 2024, either US or globally, rate hike cycle finished, full employment, fiscal support. We expect a pretty decent economy overall.
Yeah, you mentioned the words battle-tested economy. Now, the next topic we're going on to is politics, and I feel like a battle is definitely coming up in 2024, and it bores me to tears, but it's a very passionate thing here in the US. So what do you think is going to be happening with all that next year?
Yeah, well, I mean, first off, the U.S. is the big show, obviously, but we wrote that there are approximately 40 different countries going to the polls next year, including India, for example, Indonesia, most likely Japan. So there are a lot of important elections taking place next year, but the U.S. is the principal focus, and we don't need to get into all the back and forth about what's happening. But the thing that interests us, frankly, is that notwithstanding the kind of deterioration, I think all would agree, deterioration of the political environment in the United States, foreign investors still want U.S. dollar denominated assets, right? So foreign holdings of U.S. assets, and again, there's been a lot of talk about foreigners selling treasuries. Some foreigners are selling them. Other foreigners are buying them. Net, there's not a real noticeable decline in foreign ownership. But foreigners want to own U.S. assets. And so that's at an all-time high. And it's going to be interesting to watch. Our view is as the dollar weakens, right, as that rate cycle changes, as Europe bottoms, China bottoms, Japan exits yield curve control, we think yield differentials are going to shrink. That should lead to dollar weakness. And if that starts to kind of get going, there's potential, since foreigners are record holders of U.S. dollar assets, there's potential for that to kind of change fairly abruptly. And the other point that we would make, because it's plenty easy to say, oh my God, things are horrible. The other point we want to make, and we do touch on in the monthly, is that, look, let's not forget that President Biden and President Xi of China are going to meet in San Francisco in a couple of weeks, right? So President Xi is actually coming to the United States. And this is a situation where the two leaders have not spoken to each other for roughly a year. Now, there's been some Treasury or cabinet level discussion, both with China and with the United States. Secretary Yellen, the foreign minister, China's foreign minister, was here last week prepping the ground for the two presidents to meet. But we think that's an important sign that, look, you can kind of pontificate all you want about how horrible things are. The fact that the two leaders of China and the United States are sitting down to have a discussion about how they can maybe work together and how two countries can work together, that's a positive for the global economy, the global landscape. And hopefully we'll see more of that in 2024, which is clearly going to be a political year.
And well, going with that political year, it's like you can't have policy without politics involved. But let's talk about the policy side of it. Obviously, you had the Fed last week not doing anything, and the feeling really is that they might be done. You've been talking about that for quite a while as well. And you've also highlighted a lot about the emerging markets, and there's some cuts going on out there as well. Is that the trend that we continue to see in 2024 and maybe possibly in the US?
Yeah, that's really a key point from our point of view, Scott, is that the rate hike cycle is finished. And we've felt that way for some time. The Fed has now been on hold for 2 meetings. We think the Fed is finished. And we note that there have been more central banks cutting rates over the last month than at any point in the last 3 years. There have been 30 rate cuts globally over the last month or two, the most since August of 2020, when folks were dealing obviously with COVID and people were cutting rates very, very aggressively. So importantly, the developed market, the Fed, the ECB, Bank of England, et cetera, that rate hike cycle is ending at the same time as an emerging market-led rate cut cycle is starting to unfold. The fact that the Fed is increasingly visibly done allows those emerging market countries to kind of be more proactive. And at the same time, you really have a switch from monetary policy, which is what's been driving things the last couple of years, to fiscal policy. And there's a lot of talk again in the US about, well, we have such big fiscal deficits and we're spending too much. The reality is that it's not the spending that's really been an issue for the deficit. It's that the revenue in 2023 was quite a bit below expectations, in part due to lack of capital gains because of the market environment over the last year or so. But going forward, our view is that a lot of that fiscal expenditure is already baked into the cake. We have some great charts in the monthly that show exactly that between the CHIPS Act, Infrastructure Act, the Inflation Reduction Act, there's a lot of spending that's built in that is kind of moving through the pipeline that's going to sustain economic activity. And we think, again, the case is the same in Europe with their Fit for 55 and next-gen spending there as well. Japan, if you look in Asia, Japan is obviously moving in the other direction, right? Moving off of yield curve control, letting interest rates rise. They finally killed the deflation dragon. Their issue has not been inflation, but deflation. That's no longer a concern. And then again, as we've talked about for some time, China is putting both fiscal and monetary policy work very much on a targeted basis, though. There's a lot of talk about China needs to bring out the big policy bazooka like they did in 2012 and 2013 after the great financial crisis. We've never been a believer in that thesis, in part because we traveled to China during some of those years, and it was made very clear to us that they felt that that was, in hindsight, a policy mistake. And so China much more targeted in their policy approach, and we think that's starting to really pay dividends, and we talk a fair bit about that in the monthly as well.
Okay, and that always brings it up, rounding it up to the markets. And listen, there's technical side of it, people talking about 4,400 on the S&P again and so forth. So there's no real surprises of people talking about that, but do you have some surprises for us?
Well, we did talk at the outset, right, that we had 4 macro surprises and then 4 market surprises. And we wanted to come up with symmetry there. So for each, and we do have therefore some market surprises. And the first is that the big winners from lower U.S. inflation are going to be outside the United States, right? With, again, our kind of throughput is quite straightforward. Lower inflation leads to lower rates, which leads to a weaker dollar. And the dollar, in our view, really holds the key. Dollar weakness sets the opportunity for the rest of the world to outperform. And keep in mind that the rest of the world has not only potential earnings growth as their economies recover, but also very compelling valuation, right? There's been so much attention paid to the United States that the gap between U.S. and rest of world valuation, as well as the rest of the world's valuation relative to its own history, are very, very compelling. And so that is something that we think is really like the first surprise. You think of, wow, inflation's coming down in the U.S., then U.S. must be good opportunity. And that's not to say that U.S. may not be a decent opportunity. We just think the opportunities are better elsewhere. Another on the fixed income side spot that we like in this environment is emerging market local currency debt, which should again be a big winner. One, from currency strengthening versus the dollar, and we've seen some of that just in the last couple of weeks, some pretty aggressive moves, Mexican peso, Brazilian real, et cetera. And then secondly, the carry that they have in terms of interest rates, real rates in Brazil and elsewhere being in 6, 7, 8, 9%. So lots of room for rates to come in. And so that's on the fixed income side, emerging market local currency debt. The second surprise is that as the dollar weakens and rates come in, things like future tech and clean tech, the stuff we were talking about in the climate section, should have a real opportunity to do well. Again, because those segments of the market were the ones that have been hit the hardest, with people worried about access to finance, access to credit, all the things that we were talking about in some length over the last couple of months. Those segments are down 20, 30% just in the last couple of months alone. So that's the second surprise. The third surprise is that we expect commodities to do well in this environment. Again, if we're right with our early cycle thesis on the global economy, industrial commodities, and here thinking more about the metals than necessarily like oil. We're so talking here more about copper, iron ore, things of this nature. We think that segment in the commodity space is quite attractive in the environment that we see coming forth. And then the fourth and final is one that we've talked about already for a month or two, and that is the idea that China really presents an appealing risk-reward opportunity here, Chinese equity, with the thesis being that we've had record foreign selling, we have a huge valuation gap. China now trades at under 10 times forward earnings as an example of attractive valuation versus 18 times for the United States. And so we think the risk is quite limited as we see the policy traction being gained, and the reward is quite significant given that we've had a valuation discount, as I just said, 9 times forward versus 18 times forward. That's a pretty compelling discount. So as we think about it, to finish up with a couple of thoughts, one is that you have a situation where sentiment, positioning, and technicals are all supportive of a continuation of what we saw last week. Not in the same magnitude, obviously. The S&P was up about 6%, so unlikely to have many weeks of 6% per week gains. But if you look at a lot of factors, again, sentiment, positioning, technicals, add in seasonality to that, there's a lot to suggest that there's pretty good upside between here and the end of the year. And it makes perfect sense, right? Because if you think about it, a lot of institutional managers are finding themselves behind the 8 ball as we approach the end of the year, right? And that's not a good place to be. That's exactly what fuels the famous year-end or Santa Claus rally, is when managers are underperforming and they have a date certain where their performance gets cut at the end of the year. And so they chase into year end. The other place where institutional managers don't want to be is starting the year out behind the performance 8 ball, right? The only thing worse than being like at the end of the year is being behind performance at the beginning of the year, when you've got you have an ugly slog over the course of the year to try and make up. So I think the fact that institutions are heavily weighted in cash, that hedge funds, long, short, I saw something over the weekend from Goldman Sachs, I believe, long, short hedge fund net exposure is at a 5-year low. Technicals are very supportive with some breadth thrusts over the course of last week. Seasonality, very supportive. So, we have been pretty constructive, and we had a great first half of the year. The third quarter was pretty challenging. But, we continue at this point looking forward, both through now into year end, and then looking more into that 2024 outlook period. We're pretty constructive, both on the macro. We think positive surprises are going to unfold, and that on the market side, there are likewise, some positive surprise areas where we think opportunities are really pretty compelling. We achieve macro stability, dollar weakness, people start to look offshore, realize, hey, not only is there decent growth, but the valuations are really compelling. And that's the stuff that kind of leads to potential double digit type returns over the course of the next 12 months or so.
Well, Jay, thank you very much. A great monthly and a great look at the year ahead, and a lot for people to think about. And we thank you very much for your insights.
Absolutely, Scott. Pleasure to be talking with you as usual.
And for everyone else out there, good luck investing.